Gap trading the void. Let's move a little deeper into this concept of voids. Prices move between areas of support and resistance. That's Technical Analysis 101. As new areas form, we need to update that information. However, when there's a price void, which is what gaps create, there's going to be better odds of prices moving rapidly or trending. So as we're going through our gap scans, we're looking for stocks that are not only gapping, but also have voids. So when there are no areas of congestion, swing highs or swing lows to the left of current prices, the odds are that prices will have the ability to move with relative ease. So here's what we're looking for. This is from the point of view of prices moving very rapidly. However, a gap also creates that void. Now, as prices move sideways or over time, that increases the size of this void. So as we view this from an intraday chart, and this would be yesterday's close, and this could be today's open, and then over the course of 2 minutes, could be 10 minutes, prices begin to move sideways. And of course, we're going to look at individual candlestick patterns to put in alignment with this concept to give us high probability opportunities to trade in that void. The last point here, the sideways movement over time dissipating what little reference point there may be, what that is to mean is that whatever congestion there could be to the left, for example, prices began to move up at this level and then go sideways. As time goes by and more data comes into our chart, what's directly to the left here is going to become less and less meaningful as a reference point. So if prices should break down into the void, what's to the left here is going to do very little to stop prices from moving lower. On this chart, we'll look at a couple of examples of voids being created. And here we have an unfilled gap, which would be a reference point for us in the future. But what we're interested in here, as it relates to trading gaps, is the fact that prices gapped above all of this resistance here. And we could see that sellers came in here. You can see the topping tail. And then sellers came in here as it retested the topping tail. As it created this little support point here, as I say, it's building an area of support, which we don't know will be support until prices actually cleared that resistance area. But once it gaps above here, we know that buyers are in control, and the odds are that prices are going to move higher. So this is definitely the kind of pattern that we've reviewed and will be looking at to trade gaps. Here is another gap that was actually filled that happened after this correction bar. So this bottoming tail bar or correction bar here suggests continuation. What we would be looking for here as it relates to gaps is the filling of this gap in the morning intraday as it comes down into here, looking for a continuation after this correction bar. Another area where support is building after a move lower, and this pivoting here, as I like to call it, which means it was moving down, it stalled and started moving back up again, and then there was a retest of that area, building support, and then prices gapped up. Another pattern where a gap above this area of support is suggesting a move higher. And here we can see what's a relatively fast momentum move to the downside, creating this void, and then this sideways movement over time, increasing the size of this void. And we could just look at this in this way, meaning here's this movement down, if we look at it in just a line chart, and then this move to the downside creates this larger void area. Over time, these reference points of resistance, potential resistance, become less meaningful as prices move sideways away from it and this area of support builds up. So once prices clear it, putting this all together puts the odds in our favor that prices should move up. And as I said on a prior slide, these patterns do not suggest this type of movement. We have this huge green candle here moving up this much. But there is the potential for that. Here's a gap above this resistance area, which is created, I'm going to call it gap void. Now, what's over to the left there? Well, we just need to go and look to see what's there, and we could do that by expanding the chart. We could look at a higher time frame, but we're definitely going to look what's over to the left there to see if there's a void above. We know that there's a void below, and we know that because prices were going sideways here and we're moving down, note the red candle here, and then gapping above that resistance area suggests that prices are going to go higher from that point. Prices could also go down. Of course, they can go in either direction. But the big picture, the daily time frame and what I've explained suggests that prices are going to go up. So that's our bias. Prices could come down. I've marked here where that support is, and if they did, let's assume that this red candle followed through to the downside. We'll be going over setups like this. If they came down into the gap fill area, we would be looking for this same type of a pattern here to go long in that area of support. If buyers are stepping up, they can create new support, and that's what's happening here. And as we look at these individual candles that are forming, we look at what I call bar by bar analysis. We can go through that here, where we have this topping tail red bar strongly suggests a move to the downside. And the next candle, you can call it a doji. We could just look at that fact that the open and close are close to the same. That tells us that momentum slowed down. Doesn't mean it can't go lower at that. It might. However, the next bar is a green candle closing above its open, and as it approaches this prior high here, which is going to be resistance, we're going to look at what the reaction is going to be to that. And this price action right here, this little sideways consolidation that happens over the course of 6 minutes, we're looking at a 2-minute chart. Looking at this bar by bar, we then see that prices backed off from this high. So the concept that I mentioned about this resistance area and prices moving sideways away from it, making less meaningful, is applicable also to a small time frame like this. Just to reiterate, we've got our big picture bias here with this gap up. So we believe that prices are going to go higher. I've looked to the left. There's a void over here. There's nothing to stop it from going higher. Now this pattern here begins to create support. So looking at this bar by bar, as we've explained, a bottoming tail bar tells us that sellers came in, it went lower. Remember, we can see that sellers are trying to take control over here. Gap up is going to create sellers fade the gap. In addition, we can assume that there are those that bought here and were in pain that are very happy to actually be making money while they were holding a loss. And they would be selling first thing at the open, potentially. But as we see what's happening here, we see that buyers continue to step up. They're absorbing the little bit of supply here that occurred in those first few minutes. And then the bottoming tail bar tells us that buyers are stepping up on the dip. And then we get another one. And that is where we need to take action above this high here. You could buy it above the high of the day. But these bars are telling us that it's going to go higher. And at some point, this might all happen at the same time because prices do move relatively fast at these times. By the time we actually press the button, it might be here. Overall, our bias is that it's going to go lower. And of course, we don't want to see it moving down below the low of the day. And then we'll manage accordingly. Gaps that'll form that we have to be aware of that are not really meaningful, we have to put them in the context of what happened, is stocks or ETFs that are going ex-dividend are not gapping in the way we're interested. They're just adjusting for that dividend distribution. And here we're looking at the S&P spiders that gapped down that day. And initially this does look like a bearish pattern where prices had moved up. They went sideways and then gapped down. But if we look at the S&P cash index, which doesn't take into consideration that cash dividend, we see that really nothing happened here. ADRs also gap almost every day. They're traded primarily in a foreign market, but trade in the U.S. too. When the U.S. market opens, they have to adjust for that, and they gap. So these are not the type of gaps that we are interested in trading either. We're putting together the building block. Now we talked about what defines a gap, what is significant, and what is shock, what's professional, what's novice, what's avoid, what's building or creating support. We didn't talk too much about resistance, but it's the same concept, just reversing the chart in the other direction. And as we put this all together, it formulates a plan for how we're going to rate gaps and how we are then going to trade them based on that. Now let's go ahead and move to the next section where we'll be rating gaps.